This last day of, yes, the quarter, but the month as well. The month that is notorious for being among the worst for stocks. The bulls can actually breathe a sigh of relief because all the majors look to end this month in the green. Who got us there? Well, Warner Brothers Discovery, Western Digital, Seagate Technology, Micron, and Intel. Those were the best performers for this month. But as we know, where there are standouts, there are always slackers. The worst performers, well, CarMax, FactSet Research, Kenvue, Synopsys, and Constellation Brands. With 54 minutes left to trade in the month, we want to spin it forward. So as you know about October, if September's a bad month, October is also known as one of these very sketchy months. Do investors face a fabulous or frightful October? Let's get right to the floor show. Joining me now with $1.64 trillion in assets under management is Franklin Templeton Research Institute head and chief market strategist Stephen Dover. Stephen, good to have you. Look, September defied the odds and the almanac. Does that make October the month where the correction callers might finally be correct?
No, we don't think so. We think that with rates dropping, the market's going to broaden, and we're actually quite positive and constructive on the market. We did a little bit of research. We looked in the last 50 years in the 8 instances when the Fed cut rates after a pause. 100% of the time after those rate cuts, the S&P 500 was up, averaging 17%. The NASDAQ was up, averaging 25%. The Russell 2000 was up, averaging 20%. And most of all, emerging markets were up, averaging 27%. So you know me, we've talked quite a bit in the past. I have a value tent, so it's unusual for me to say this, but I actually think that we see a broadening in the market. There's a lot of cash on the sidelines right now. A lot of people have missed this huge upward movement in the market since April, and they're trying to figure out how to get back in.
I want to flag our viewers on something because you talk about the Fed and you talk about how well the market does after a rate cut cycle, or at least in the middle of it, Stephen. In just a few minutes, we have a voting member of the Federal Reserve coming on, Austin Goolsbee, the Federal Bank of Chicago. And I'll tell you, he has been very concerned that we do still have food inflation. And therefore, I'm not exactly sure that another rate cut or 2 or 3 is still in the cards. Are you?
It's very hard to say because, as we all know, and you've well reported, the Fed may be becoming a little bit more political. But we think that it is likely to have some rate cuts in the next 2 meetings of 25 basis points. So we're sort of in line with the market, but it is less certain than it has been in the past. Look, I think you point out something really important, and that is we have 2 tail risks. One is that, inflation is more persistent, but the other, of course, is that the economy might slow down. We think that we'll muddle through this. We don't necessarily think there need to be rate cuts, but we think it's likely to happen.
Okay. All right. That said, where do you invest? I know that you feel that there are 2 areas, emerging markets and Europe, that actually look better than the United States, even though our markets are at records?
Yeah, so our main themes that we're looking at, looking broadly, we call it broadening, flattening, weakening, meaning we think the market's going to broaden, moving beyond those 7, so Mag 7, so we're pretty positive on small caps. We're positive, yes, as we mentioned, on emerging markets particularly, and somewhat on developed markets. Now that follows with the yield curve flattening. Let's remember that whatever the Fed does, I think people forget the Fed doesn't control interest rates over the entire spectrum of interest rates, but rather short-term interest rates.
Okay.
It's the market that really determines 10 and 30-year rates. So we think, yes, the Fed will lower, but we don't see a lot lowering of the 10 and 30 years. So that steepens the curve. And then finally, we think the dollar will weaken. All of that bodes well for emerging markets and for overseas stocks.
Well, I do have to jump in here and ask you, aside from that, the earnings picture, you think that the European companies and the emerging market stocks will have better earnings and even better than, say, the hyperscalers here in the United States, which clearly have a lot of money coming in?
No, I don't think they'll have better earnings, or certainly not better earnings growth. There's no engine like what's going on in the United States, and we're certainly not saying to move away from the United States. There's so many positives going on in the United States. I think the United States will continue to dominate. That said, the United States is so far ahead market-wise, especially emerging markets, but also somewhat developed markets, that those markets aren't going to have the growth that the U.S. has, but they're also less valued. So the delta change allows those markets to appreciate. I think the real story is a lot of people are sitting on the sidelines. It's a classic value trap that you thought the market was going to go down, or you were going to buy, and the market keeps going up, and you keep waiting for opportunities to get in. So what we're saying is we think the market is most likely to be up a year from now, and that investors should take this opportunity, whether it's the government shutdown or anything else that weakens the market a little bit, buy on dips over this period of time. It's not a good idea to be in cash right now. Cash is increasingly not going to have that 5% return we've enjoyed for a while.
Well, that is true. If rates were just cut by 1/4%, you know that the follow-through is definitely there. Stephen, it's good to have you on the show. Thank you very much, Stephen.
Good to see you again. Thank you very much.
Wish we could see you, but your video froze, but at least we can hear you, and that's the meat of the matter.